Part 2. Participants within the auction process. Robert Collier once said, "Success is the sum of the small efforts, repeated day in, day out." Welcome to Part 2. I hope you managed to complete the playbook from Part 1 easily. In Part 2 we're going to discuss three main principles. The first will be key market participants. The second will be key time frame participants. And the third will be the basic auction process. So let's get to it. Key market participants. It is obvious that there is a buyer for every seller and a seller for every buyer. Whilst it is obvious, what many fail to understand is what time frame buyer or seller is making the sale or purchase. This powerful piece of knowledge unlocks key information about potential for future direction. What do we mean by this? Well, simply put, if we were to observe prices going higher in a market, the basic assumption would be that there are buyers or more buyers than sellers in the market. However, sometimes it's not actually buyers that are taking the market higher, but shorts that are covering their shorts and buying out of those shorts, which is taking the market higher. Understanding what moves prices or what time frame is moving prices or which participants is key to unlocking future direction. By observing the auction process unfolding via volume profiling, we can begin to assess the attitude and interaction of different time frame participants. It's imperative, guys, as we go through the rest of this module and the strategies in module 2 and 3, that you understand how these different participants are interacting. Because it's this interaction that is going to lead to success or failure of the various trade setups. Let's talk about the three major participants: commercial, speculative, and automated. The first and most influential, commercial. This includes pension funds, insurance funds, hedge funds, large institutions like banks, and hedges or hedging strategies. Now, in order to understand how commercial participants move the market, we need to first look at the characteristics that define commercial participants. The first characteristic, not price sensitive. What does this mean? If we were to take a basic example of a hedge fund, let's say they get into a long position and the market and the price starts to go against them. They're not too concerned about which price they get out at. Why? Because their objective is to just lock in profits. So once they get out, they are executing at the best price possible regardless of where it is. Equally, if we take the example of a pension fund, every month they need to rebalance their portfolios. If at the end of the month they find themselves short of bonds, they have to buy those bonds due to regulation. So they are not going to be calling up the banks and worrying too much about price. They're merely going to execute at the best price possible. This lack of being price sensitive can sometimes drive markets beyond certain points that we are used to, and it's important to understand why they're being driven in such a way. Our next characteristic, natural hedging. A lot of the large institutions tend to execute via hedging strategy. This means they're long one market and short another. This can sometimes create confusion, as we would expect all bond markets to be highly correlated. Yet sometimes they move in opposite directions. It's important to understand these hedges, as this can cause us a lot of frustration in various setups. The next characteristic, capital preservation. Again, a crucial understanding for commercial paper is that they are expected to preserve capital at all costs. And that is why sometimes we can see some very aggressive moves in one direction and the other as these large institutions enter into the market with paper in order to preserve capital. Trade value. Large commercial institutions don't always participate in the market. They rarely participate within the middle of ranges. They tend to be found at the lows and highs of certain moves in markets. Why? Because their objective is to buy when a market is perceived cheap or at a discount, and sell when the market's at a premium or at a high price. It's important to understanding that they trade around these values, because sometimes as traders we expect paper to enter the market or commercial participants to enter the market every day. Yet more often than not, they're only there over the period of a week on the odd occasion. Then, they influence market prices. Highly crucial to understand. commercial participants can move prices up or down. So crucial to understand, as they are probably the single most important participant that can move the market. If they can influence prices up or down, we need to always be aware of when they enter the market and definitely not go against them. Let's now continue with the second of our key market participants, the speculator. The major difference between the speculator and the commercial participant is that the commercial participant tends to interact in the market and hold positions based on various fundamentals or various technicals, and they do tend to hold these toward maturity. Whereas the speculator, they tend to hold until a profit target has been reached or an objective, a specific objective has been reached. They speculate on the direction of price, whether up or down, and take advantage of that. Once it has occurred, once the advantage has been taken, they then exit the position, whereas commercial paper tends to hold on to the position. So what are some of the characteristics that define speculative participants? Well, first and foremost, speculative participants can be short or long-term, or even algorithmic. They tend to move price between longer term players. In other words, they tend to facilitate trade between the longer term participants. They bring the longer term participants into the market by moving price up and down. Speculators tend to be price sensitive. What do we mean by this? Well, when prices move up or down, speculative positions tend to be unwound or put back on. Because they are price sensitive in nature, they can sometimes also move the market quite aggressively in one direction or the other. We will discuss various strategies based on speculative positioning later on in the course. Speculators tend to position with risk in mind. So they tend to enter at one point, but they do have a point where they exit the position or take the opposite side of the position to get out. Again, important to understand, as sometimes it's speculators that are moving prices up and down as opposed to paper commercial participants. Speculators tend to take advantage or trade short-term anomalies within the market. Again, once that anomaly has been taken out of the market, they tend to exit those positions. And speculators tend to be non-influential on price, so they can move price, but not in the same aggressive manner that commercial paper can move the price. Again, important to understand, because sometimes what happens is speculative paper might move the market too far in one direction as a result of stops going off, and once those stops are taken out, we do tend to then see a rapid rebound in prices. So again, important to understand as we will discuss strategies based on this at a later point. Now, let's talk about the third key participant, the automated algorithmic strategy, or algos. Again, important to understand the key characteristics that make up these algorithms. Note, algorithms by their very nature are very short-term and they tend to make up roughly 90% of the trade in most markets. Now, it's key to understand this. If 90% of the trade is made up with short-term algorithms, we need to focus quite heavily on what their objectives and goals are of algorithms, because we are going to be participating predominantly with these algorithms. So, another characteristic, their execution methodology is precise with exact entry and exit parameters. What this means is that they very rarely make mistakes. They very rarely hold on to losing positions. Yes, sometimes it does occur that they do, such as the flash crash. However, in general, they are very precise with their execution methodology. Algorithms tend to speculate using high frequency, so they do a lot of trades very rapidly, in and out, in and out. They tend to have very small downside with open-ended upside. So again, very often we can see markets sometimes moving very quickly in one direction and then reversing the trade. And this is more just noise or positioning unwinding happening within algorithms. Algorithms look to fill orders at best price practice within parameters. So again, algos are after the best possible price, and because they can rapidly execute these orders a lot quicker than us, we need to understand their methodology in order to assist us in developing our own edge. Algorithms tend to facilitate trade, which is the same objective as the day trader. So important we understand this, because it means that as a day trader, our edge is not necessarily disappears, but it's eroded by an algorithm or computer that can execute far better and far more efficiently than what we can. So again, important to understand this as we develop our edge as a trader. So, the key when it comes to trading market participants, we need to be able to answer the following. What are the goals, objectives, execution styles, time horizons of the various participants? If we can answer these four dynamics and understand the characteristics of each participant, we can develop some incredibly good strategies, just knowing how each participant is interacting and where and when they interact. Now that we've spoken about the various key participants in the market, let's talk a little bit more briefly about the various time frame participants that you can find in the financial markets. The most important thing to understand about time frame participants is change. What do we mean by change? Change influences market participants of every type, from the day trader to the long-term portfolio manager. Very simply put, change is merely prices moving up and down. This movement brings into the marketplace various different time frame participants. Let's use a basic example. Say now we took out the previous extreme of a previous day. The minute we take out that extreme, we're going to see other time frame participants reacting or responding to that change. It's that reaction that will dictate the future of price. And it's that reaction we need to understand and interpret in order to take advantage of the future movement in price. So let's talk a little bit more about some of these time frame participants that you can expect to see. The first and the shortest term time frame is the scalper. The scalper lives by the minute hand. It continually buys and sells in order to take advantage of discrepancies within the order flow. They are a master of reading order flow and rely solely on order flow. In essence, the scalper tends to be algorithmic in nature, however you do get human scalpers. They tend to execute large amount of orders, small winners and small losers, and they're exact in their execution. Let's now take a look at a chart whereby we'd be able to see scalpers interacting. As you can see, on the left we have a basic profile. On the right we have a 1-minute chart. Now note the reason we have the 1-minute chart is because this is the time frame that scalpers tend to react on. Every little bit of movement up and down the page is a scalper, interacting continuously as prices move up and down. Now as we can see, in the example provided, we spent an entire day within the previous day's range. Most likely, there was very little participation from other time frame participants. Most of the participation would have likely been the scalper. Understanding this will allow us to interpret what could occur on the next day. Let's talk about the next of our time frame participants, the day trader. The day trader tends to enter the market with no position. More importantly, the day trader leaves the market without a position. It has zero risk overnight. Day traders tend to use technical analysis and real order flow in order to make trading decisions. They depend on market-generated information. Fundamentals tend to be slightly counterintuitive to the day trading participant, as they tend to hinder the day trader as opposed to adding value. Let's take a look at the same example used in the scalping in the previous slide. As we can see, we have an inside day. Traditionally, inside day breaks, day traders tend to play or go with the break. As we can see, day traders will enter the market or will enter the market once we take out the previous day's high. They will be looking to hold for a continuation type pattern to the upside. However, do note day traders manage risk very effectively, and any attempt at the market to re-enter the previous day's range, day traders will tend to exit those positions and zero their risk. This is a typical play from a day trader. The next time frame participant we're going to talk about is the short-term traders. Short-term traders tend to hold trades for longer than a day, sometimes even up to 3 to 5 days long. Short-term traders give more attention to the technicals and fundamental factors. Just like the day trader who focuses on technicals, the short-term trader includes fundamental factors into their trading strategies. Short-term traders have a tendency to buy low and sell high, looking for momentum breaks and momentum continuation patterns. Short-term traders accept and interpret fundamentals whilst using market-generated information. The key major difference between a day trader and a short-term trader, as we can see in the example provided, is that, as we said in the previous slide, a day trader will look to play for the breakout of the inside day. Once or if that re-enters the previous day's range, the day trader will have a tendency to exit that trade and flatten its risk. A swing or short-term trader, however, would be more willing to hold on to that trade with a slightly bigger risk in the hope of slightly bigger profits. The next time frame participant we're going to discuss is the intermediate trader or investor. Intermediate traders or investors, also known as swing traders, they're very similar to short-term traders, but they operate from a slightly longer term time frame. For instance, a short-term trader would tend to operate from, say, a 30-minute to a 60-minute to even a daily candle or a daily time frame. A intermediate trader or investor would tend to operate from a 60-minute, 4-hour, daily, weekly, and monthly type time frame. The intermediate trader finds a strong balance between fundamentals and market-generated information. So they're equally balanced between technicals and fundamentals, whereas the day trader leans slightly more towards the technicals than the fundamentals. As an example, if we look at the profile below, as we can see, we have very strong trend-like type profiles. Now, an intermediate type trader or an investor will look to continue to hold this market so long as it keeps holding this one time framing pattern or making these higher lows and higher highs. As we can see, they tend to use daily type candles as opposed to the shorter term time frames that the short term trader would typically use. The last time frame participant and the most influential time frame participant is the long-term investor, also known as paper traders. First and foremost, they're not price sensitive. Paper traders tend to focus heavily on the fundamentals, giving more attention to the fundamentals than the technicals. When they're active, they tend to have very large orders and they're quite visible to the market, these orders. More importantly, these orders don't tend to just occur for one day, but they tend to be ongoing for a number of days, even weeks. Long-term paper is responsible for breaking new ground and starting new trends. Fundamentals are far more important than market-generated information, and most important, they're not price sensitive, and that is why they're very price influential and why they start new trends. As we can see by the example provided, this is a daily type time frame. Longer term investors tend to focus on the fundamentals given to us by central banks, the data from various nations, as well as all the macro events occurring around the globe. They then tend to use the technicals to confirm the fundamental picture that they understand. Now that we've dealt with the 5 market time frame participants, let's summarize them and get a very good overview of these 5 participants. Remember, in order to understand the strategies we're going to use at the back end of this module and module 2 and 3, we need to understand the 5 different participants. More importantly, we need to understand how these participants interact with one another, where they tend to interact, and what type of change in price brings them into the marketplace. So let's look at the summary table. As we can see, we have the scalper, the day trader, the short-term trader, intermediate swing, and long-term investors. I've summarized this in the 6 key characteristics that you can find amongst these 5 participants. For example, the scalper. The scalper tends to be pure price action and technical, whereas the day trader tends to be technical with a little bit of fundamental. The short-term trader is technical and then fundamental. The intermediate swing trader finds a happy balance between fundamentals and technicals, whereas the long-term investor is purely fundamental and uses the technical to confirm the fundamental backdrop. If we then look at the second characteristic being the time frame, scalpers tend to react on a second to minute type time frame, day traders minutes to hours, short-term traders hours to days, the intermediate swing trader days, and the long-term investor days to months to years. We then turn to the liquidity provider or user. Scalpers tend to provide liquidity to the market. Day traders provide liquidity to the market. Short-term traders provide liquidity to the market. Intermediate swing traders provide both liquidity and they use the liquidity, whereas long-term investor paper traders are liquidity users. Our next characteristic is price sensitive versus non-sensitive. As we can see, scalpers are extremely price sensitive, whereas day traders are price sensitive but not as much as the scalper. Short-term traders are relatively less price sensitive than the day trader. Intermediate swing traders are not sensitive and neither are the long-term paper investors. In terms of order size and volume, scalpers tend to be the smallest, with day traders small. Short-term tend to be relatively small, whereas intermediate and swing traders tend to have larger orders, and the largest orders and highest volume comes from the long-term investors and paper traders. In terms of influential on price and not influential, as we can see, the scalper is not influential, the day trader is not influential, the short-term trader is not influential, the intermediate swing trader is influential to an extent, but the most influential is the long-term investor. They can move in markets wherever they like and however they like. That's a wonderful summary to keep close by as we go through not just the rest of this module, but modules 2 and 3. Let's wrap up our key time frame participants. First and foremost, it's important to understand that whilst we've identified these 5 participants individually to try and understand them and understand the characteristics of each time frame participant, it's important to understand that at any given moment in any given market, all 5 participants can be responding or reacting to the change together. Now, this will complicate the process altogether. However, when we go through the various strategies, I'm going to show you how to break down and understand which time frame participant is responding in each strategy. Then, most important to understand with regards to time frame participants, who is in control? If it's the paper longer term institution in control, we do not want to fade that. We do not want to develop strategies to fade that. We actually want to develop strategies to go with that. However, if it's the shorter term time frames that are in control and they're just moving the market in between ranges, then that kind of a market we can look to either go with or fade. So it's important to understand who is in control at which time. Note, trading requires a great deal of mental flexibilities. Traders who integrate discipline, emotional control, and agile market understanding are generally able to let go of prior patterns that are no longer working. It's so important to understand that when developing trading strategies with the various time frames, because sometimes the strategies are just not going to work. And we have to accept this. More importantly, we have to be willing to be nimble and flexible so as to adjust with the varying conditions of the marketplace. To be successful, investors must recognize the confluence of evolving factors that will eventually lead to a changing market atmosphere. Very simply, what this means: change is occurring all the time. We need to make sure that we can recognize this change, recognize what is making these changes in the market, and recognize how we can change in order to take advantage of this change. To summarize, knowledge is little. To know the right context is much. To know the right spot is everything. Hugo von Hofmannsthal. To summarize, the markets are constantly changing. It's this change that we need to be able to take advantage of. Let's now discuss the basic elements of the auction process. Auctions. Auctions are made up of 3 fundamental elements: price, time, and volume. Price advertises the opportunity, time regulates each opportunity, and volume measures the degree of success of each auction. This is the key fundamental pillars behind auctions. In order to understand any auction, it doesn't matter what the market might be, you need to understand price, time, and volume. What this is telling us, in an auction, as price moves higher and lower, It's an advertisement to anyone participating within the auction. If there are high prices, various participants will participate. If there are low prices, some participants will participate. If there are fair prices, some participants will participate. At each price, there's a different advertisement for different participants. In terms of the time measures and regulates each of these opportunities. The more time it takes, the more participants have to engage at various opportunities. Less time at a specific price represents a very advantageous opportunity, whereas a longer time at a various price represents not as advantageous. In terms of the volume, higher volume tends to tell us there's a lot of success of the auction, whereas lower volume tends to tell us there's less participation or less involvement at those prices. In terms of fair value is the price level that's attracting the greatest volume of trade. So fair value is where we spend most of our time trading. Why? Because fair value depicts or tells us the point in the market where buyers and sellers are in agreement. If they are therefore in agreement, it's very, very difficult to expect buyers to buy up higher prices and sellers to sell lower prices. And that is why we tend to spend a lot of time around fair value. Identifying fair value is pivotal in understanding forces within a market. The reason being is, once we've identified fair value, we then need to be cautious expecting a resumption of the trend. Markets can spend a long time trading around fair value before continuing in one direction or another. And that is why it's pivotal to understand when a market has found fair value. In terms of volume determines whether or not divergences from value can be sustained. Some days, buyers and sellers can be discouraged from moving away from fair value, and this is known as mean reversion. On other days, however, we can see price move very quickly away from value as it attracts interest in the form of volume as the market starts to accept a new fair value or a new value area. This is important to understand as it's telling us when a market decides to move away from fair value. The key factor to watch when a market is moving from fair value is the volume. Higher volume tells us that the market is accepting moving away from that fair value, whereas lower volume tells us the market is actually rejecting or not happy about moving away from fair value, and more often than not, this tends to mean revert. So to summarize, the objective of the market is to facilitate trade. That is why the marketplace was created, to facilitate trade. Now the question you have to ask yourself, is it doing a good or a bad job at facilitating trade at various prices? And we can see that facilitation in the volume. High volume suggests that we are doing a good job, whereas low volume suggests we aren't.
Well, ladies and gentlemen, here in Seattle and watching around the country on NBCSN, it is time to bring out one of the most desirable and valuable muscle cars on the planet. A 1971 Hemi Cuda 4-speed convertible, one of only 11 built, only 2 were sold here in the U.S. This is the documented only numbers matching 71 Hemi Cuda 4-speed convertible known to exist. Mark Delzell, let's sell this car.
This is one of the top dogs of the auction, and actually, Scott, in the performance car world, one of the top sellers for calendar year 2014. This is big news. The big question is, how much will the Mopar Hemi market recover from the adjustment that we all were well aware of back in 2008? It's all coming to a head right now in the next couple minutes.
And it's already
going to make some history.
It's already at $2 million, guys.
Wow.
I'm just out of breath and got goosebumps as this event is happening right before our very eyes.
Let's talk about what might draw this much interest to this car. First of all, the Hemi from the 1960s really represents everything that was going on with the outrageousness of the horsepower race between all the manufacturers. And it really is considered to be 1971 for the Mopar gang, the absolute end of the line for that. And the rarity, the performance, the presentation of this car, and the fact that it's still sporting its original power plant, Bill.
And if you go back to 1971, you asked the question, well, why did Chrysler only build 11 Hemi convertibles? Well, convertibles, by and large, were heavier than the fixed roof cars, and if you really wanted a Hemi Cuda, you were going to go out and probably, engage in some street racing. Woodward Avenue comes to mind, or even take it to the drag strip. And the real high-performance aficionados, they didn't want the extra weight of the convertible, so that was another reason why so few of them were built.
Love the plain steel wheels with the hubcaps. We got a nice look inside the cockpit. No console between the bucket seats, but that pistol grip shifter commanding presence of its own. No console needed on this one.
$2.8 million.
Guys, let's not underestimate the impact of the provenance of this car. It is extremely well documented all the way back to the original owner. There's very, very few gaps in the provenance and documentation.
What year was it, John? 2002 that the documented first muscle car sold for over $1 million, 10, 12 years ago, something like that.
Right.
2.95 now.
Okay, because I might get him up to 3.2 or something. I don't want to lose it for.
You know, if the last 12 or 13 years have taught us anything, there was Hemi hysteria back, in that time when anything with a Hemi was way overvalued, and now it's a much more discriminating market, and these are the cars that the money people want to own.
Got 3, Kevin.
And even $3
The other guy might come
million.
back if I take the reserve off, but I got 3.
Yeah, but when I go to replace it, I'm going to have to pay more for the next one.
That'll be 4 or 5 years, though.
Yeah, well, if I don't sell it, then I don't have to worry about it.
Got 3. You want to sell it? Got $3,050,000. 3-1.
I wonder what the number is that gentleman has in his mind that'll take to pull the trigger.
3-2. Do it. 3-2.
Two bidders on the phone back there in the back with Wade and Frank Meekin in the far background.
It's the battle in Seattle.
3-3. 3-3. 3-3. Tell your guy it's going to take 3-5.
Sir Dana, 3.5 is the magic number.
Yeah.
He's in at 3-3, but he's a high bidder, but he won't sell it.
What's another couple of $100,000 when you're already at 3.3 million?
3-3-50.
Well, they're working their way up.
You know, this is the kind of thing that Dana Meekum lives for, isn't it, JK?
Dana and Frank Meekum
Yeah,
both.
right.
A piece of paper.
We just may see a world record here, Scott.
Dana's out with a notebook and crunching those numbers.
Even though this car has been restored, I still consider it a survivor. Original drivetrain, Just think of how many different things could have been done to this car over the years. It would not make it as original as it is.
Yeah, that's a great point. Yeah, absolutely. We said earlier the only documented one with the original engine still in existence.
You know, talk about this for the future, too. You're close.
I don't know if there's any more there, Kevin. We take the reserve off, the other guy might bid. Got an inch of 3.3. That's 80 grand from where you needed to be. Huh?
No. I remember what we talked about.
Okay.
Hard to judge that buyer.
$3,450. Reserves off at 3.5.
Still not there. Frank's back in the background talking to his guy on the phone.
You don't get another shot, Ross. I know. Give me 3.5.
You know, Frank makes a really good point, JK.
The reserve will be off. That's the only thing that's going to work.
When's the next time you're going to see this car on the auction block? I mean, you've got an opportunity to buy it right here and right now, and you might not get that opportunity for a while.
Give me 3.5. 3.5.
What do you think, guys?
I don't know.
I know.
3.5! There it is.
What's the seller going to do, guys?
Right now, the ball's in
Now
his
it's
court.
crunch time. Here we go.
Wow!
History in the making.
Oh my goodness, what a
This
moment.
will be a day nobody is going to forget. Seattle, 2014, Meekham's debut, world record muscle car.
Seattle, we love ya!
Third and final call. Sold.
$3.5 million. 1971 Plymouth Hemi Cuda. And hey, guess what? We've got an L88
Still to come.
out in the bullpen.
You know what? There's an
Warming
old
up.
saying that whoever cares least wins. And the guy stuck by his guns and said, this is what we're going to get.
Wow.
And Dana went to work and made it happen. That was amazing to see.
Man, $3.5 million. Guys, I think that might be our number one car of the auction so far.
We're now going to watch a very fascinating auction that took place in the United States. A few things I want you to watch for whilst watching this auction is, obviously we have a seller who wants to sell the car, but more importantly the seller wants to hit the reserve price. Now you're going to see during the auction he does get advice about lowering his reserve price, and he actually sticks to his guns and follows through on the auction. So watch very carefully. Note also we have two major bidders in this process. What I want you to focus your attention on is look at for instance the momentum throughout the auction, the speeds of the bid. In other words, in the beginning you'll see they're quite aggressive bids, and then you'll see it start to slow up. Have a think about where discount price is. Have a think about price skipping. Have a think about how the bid stalls and where the market or where the auction tends to find fair value. Have a think about the concept of excess. In other words, when have we moved very aggressively away from value, and what does that mean in terms of the auction? Also have a look at the change in price, so the increments in which the auctioneer moves the price. Have a watch of this auction, and I hope you enjoy. Excellent. Now you've completed the part 2 principles. Let's summarize. Let's go through all the principles that we've spoken about in part 2. I'm going to give you a few graphic examples so that just to ensure that you do understand everything I've been through in part 2. So we first spoke in part 2 about the key market participants. And we said there are broadly 3 types of participants or major categories of participants you're going to find within the marketplace. We said the first was the commercial. Okay, and the commercial, that included our big banks, it included our hedge funds, it included just our regular funds, etc., etc. So all your really big influential, market-moving type institutions that have got a lot of volume and are able to influence and maneuver the markets. We then said that we have in our second category our speculators or our speculative market. All right, and this will include obviously hedge funds to an extent, maybe some banks, a lot of local day traders, a lot of algorithmic type sort of strategies. And then in our third example, we spoke purely about sort of automated strategies. And that automated strategy would include our algos, as well as obviously some day traders. Obviously, a lot of day traders have got automated type strategies. And we said those are our key 3 major categories of participants in the market. Now, knowing that is not as important as to understanding the characteristics behind every one of those participants. And the key characteristics we want to understand with regards to each one of these is, firstly, the goals. In other words, what is the goal of, say, a bank or a hedge fund or a fund? Right? Their goal is to utilize liquidity, get big positions off, hedge big positions, buy bonds because regulation says they have to buy bonds. So by understanding that, it's so important. A lot of traders that I come across and day traders, we tend to assume that we are the market. We forget sometimes that the market was actually created for the likes of a pension fund, for instance, that needs to take the regular middle class person's pension and needs to take that pension and invest that pension and sort of capital preservation. We tend to think everything's about capital appreciation because we're speculative in nature. So it's important to firstly understand what is the goal of each one of the key market participants. We then said the second key characteristic is the objective. In other words, what are they trying to achieve? All right? An automated strategy is literally looking to take a 1-tick increment and then get out and take profit. So they buy here, take 1 tick and get out. Whereas a speculator may be saying, well, I'm going to buy here and I'm looking for it to target that point and I'm going to hold it either until I hit that point or I'm going to stop out there. And a long-term, sort of objective may be to sort of invest over a period of time and ensure that the fund is fully invested in the market. So again, it's important to understand the objective of each one of the key market participants. We then spoke about execution styles. So important, guys. And this is where a lot of people forget, all right? An automated strategy, their way of executing is very, very unique in comparison to, say, the speculative market and the commercial market. Now, a lot of the time I find myself as a trader, because I'm a day trader, I understand the way in which, algorithms make a noise all day. I understand how their little strategies, occur. And sometimes I can benefit from that, but only because I understand their style of execution. Right? Equally, I understand how banks execute. So I know when, for instance, the key market participant being a bank or an HFT or a fund, when they step into the market, I know what it looks like because I can see the execution style. Right? And as a result, that's giving me an edge. In other words, when I see big banks, big paper coming into the market, I'm not going to sit there trying to utilize fading type strategies. Why? Because I know that their execution style is to continuously go with the trend all day long. So important to understand the execution style. And then last but not least, we spoke about the time horizon. Okay, so crucial. Right? Commercial, long-term, their time horizon is far, far longer. I mean, we're talking, from days to weeks to months to years, okay? Some trends, you look at the bond trend, for instance, I mean, it's been the last 40 years we've been in a bull market, right? You look at the equity since 2008, 2009, we've been in a 6-year, 7-year, or almost 8-year bull market. So again, so important to understand the different time frames. Commercial paper a lot longer, whereas your automated strategy is much, much shorter. And again, your speculative can be either short or long. So that was what we spoke about with regards to our key market participants. We then moved on and we went a little bit deeper and we started to talk about specific time frame participants. And this is crucial. I'm going to go through an example of each one of these now because this is quite an important principle we spoke about. So we spoke about the scalper and we spoke about the day trader and we spoke about the short-term trader. And then we spoke about the intermediate or swing trader. And last but not least, we spoke about the long-term trader. Now, the crucial thing was I gave you a nice table there which identified the 7 or the 6 characteristics of each one of these. And those characteristics, I'm going to write them down here for you very briefly. They were sort of fundamental or technical. And then time frame, and then liquidity. Are they a user, or a provider? And then price sensitivity, order size, and influential. Okay, I want to go through. I don't want to, spend too much time as you got the table, but it's so imperative, guys, that you understand how every one of these time frame participants, what the characteristic is. And I'm going to do a basic example. Okay, a long-term institution is very influential on the market. All right, a long-term, participant is going to have massive order size. All right, they are definitely not price sensitive. The long-term institutions. All right. Then in terms of liquidity, they're not a provider, but they're a user of liquidity. They tend to execute over longer term time frames, days, months, years, and they focus far more on fundamentals. Whereas if you go into comparison with that, the complete polar opposite, scalpers are very, very technical. They're very short-term time frame. They provide liquidity to the market. They're very, very price sensitive, small order size, and not influential at all on price. So very key to understand all the characteristics. Now, I'm not going to go through all those characteristics, but what I'd prefer to do is I'd prefer to spend a few minutes going over examples. I'll prefer to go over a few examples of each one of these participants and where you would likely see them execute. So our first example, let's just tidy this up a little bit. Our first example is our scalper. Now, what I'm going to do is I'm just going to draw a basic day type. So let's say that was the high and that was the low. So we'll call that the low, that was the high. Now, let's say the previous day or the next day, we're sitting very much firmly inside of the previous day's range, okay? So let's say that was the previous day's candle, a nice big candle. We'll call it a green candle. Okay, now, so we're trading within this day's range. Now, in between, so when the market's sitting inside the previous day's range, it's most likely that all the activity that you're seeing is very much the scalper and maybe the day trader. Okay, and the reason for this is that scalpers, remember, they tend to provide liquidity. So their job is to take the market to a point where a liquidity user can step into the market. So that's why we would most likely in this example see a scalper and a day trader. If, for instance, we took out the previous day's high, suddenly, okay, of course, you're going to get the scalper, you're going to get the day trader. If this was a very important high and maybe it initiated some stops or a responsive buy order, we might suddenly see the short-term trader step in and buy through that previous day's high. Okay, so now all of a sudden we have both the scalper, the day trader, and the short-term trader initiating into the market. Right, again, you could find some sort of swing trader stepping in or long-term traders depending on where price is. But remember, the key to these last two participants is they tend to interact where they feel the markets are trading at either a discount or a premium. Right, in this previous example, you can see we're very much still trading in and around the previous day's range. Right, so let's take an example now where we would see the long-term trader or the intermediate trader. And I'm going to use an example of, say, a longer-term time frame flag. Okay, now a very traditional long-term pattern. As you can see, let's call this maybe a 3-month flag, and we can see the markets pivoting in and amongst a support and a resistance. Okay, now note, we had the initiative leg up in the market, and the market seems to now, every time it gets to higher prices, we tend to see some profit taking. So anyone long takes a bit of profit at higher prices. We then get some initiation at lower prices. Now, in this example, what you would tend to find, in between this range over time, right, you've probably got scalpers, you've got day traders, and you've got short-term traders. Now, where the intermediate and swing traders will step in will be most likely at these points. So where they feel they want to support the market. As for the longer term traders, they would have initiated this move from much lower down. They created the move up. Why? Because they're influential. They create trend, they set trend based on fundamentals. So once they set the trend in, right, they're very unlikely. It's very unlikely you're going to see long-term traders stepping in at the highs here. Right? The point at which you do see the long-term trader stepping in at the high, that is the point that you get the continuation pattern. So in this example, when we finally break out of this daily 3-month flag type pattern, what you would tend to see on the break is you would tend to see the short-term trader, the day trader, the swing trader, the intermediate trader, and the long-term trader all initiating for a continuation pattern. Can you guys now see with this very basic example why it's important just to, when you look at a market, try and interpret who is maneuvering the market, who's moving the market around? Because when the longer term and the swing traders are getting involved, that is when sort of the market is going to hold certain prices and trend in certain prices. Whereas when the shorter term time frame, the liquidity providers, when they're in the market, all right, you're going to get a lot more two-way trade or a lot more noise, as we call it. So that's what we spoke about with regards to our various time frame participants. Once we completed that, then we moved on and we spoke about the basic auction process. Now, very briefly, just to brief you, we spoke and we said time is our first crucial principle. And what does it do? It regulates each opportunity. And then we said our second is price. And we noted that price is an advertisement. It advertises the market. And then we said volume is effectively our measure of success. So how well price is auctioning. We said those are the 3 key principles that make up not just the auctions in the markets, but any auction you see. Okay? And then we went on and we watched a video. And we watched, a wonderful auction of a car. And the key principle I wanted you to take away from that auction, and if you didn't quite pick up on it, I'd like you to go watch that video again. But what I was trying to get across with that auction is the bid, the style of the bid. And there's a few key things to understand about that bid was, the aggressiveness of the bid. I wanted you to understand maybe the price skipping. So what do I mean by price skipping? Well, if you have increments of, say, $100,000, and then suddenly you go to $25,000 increments, and then you suddenly go to $5,000 increments, okay, every time these increments reduce, that is showing you the strength or the momentum in the auction. All right, and then we also spoke about, how we had a dropout. So initially there was quite a strong bid, there was a lot of bidders, and suddenly we only got down to 2 bidders. Alright, so again, whilst this is not necessarily a financial market type auction, it's an auction nonetheless. And price, time, and volume advertises these auctions. Remember, this is where we're going to finish off. Remember, guys, the objective of the market, the purpose that we have these markets is to facilitate trade. So what you must ask yourself whenever you look at a market is it doing a good or bad job? Okay, if the objective of the market is to facilitate trade, is it doing a good or a bad job? Right? If it's doing a good job, we don't go against it, we don't fade it, we don't even entertain going against it. If it's doing a bad job of it, something, there's an anomaly, something is not quite right. And that is also when we have a different kind of opportunity. All right, we're done here now. Time to go test yourself. Go and have a look at that concept checker. Answer the questions as best you can, and I'll see you again in part 3. Excellent. Congratulations on completing part 2. It's now time again to test that you understand the principles and concepts we've dealt with in part 2. So answer the following questions. Who are the 3 major market participants? What are their characteristics? What are the 5 main market timeframes that you can expect to see in the markets? What are the 3 key characteristics to identify within the auction process? It's that time again. We're going to apply those principles now to your playbook in a practical way. So, in this section of the playbook, what I would like you to do firstly is I want you to complete the table summarizing the 5 market participant timeframes and compare them with the summary table that I provided to you in part 2. Once that's complete, I want you to use the charts that I provided for you, and I want you to try and identify the key points or areas where the various different time frames will participate as a result of the change in price. Good luck, and I'll see you in part 3.